Manish Jain from Ambit Asset Management join us today. Manish, thank you so much for taking time out. If we go by Ambit's coffee can portfolio, it definitely is something that aims to deliver steady returns over longer periods of time. But when so much has happened in such less time, if you look at the last 4-5 months, how markets have played out, whether it's earnings, macros, rural revival, the frenzy that's back once again in mid and small cap names, what is your assessment of all these developments that took place in the last few months?
Sorry, I've lost your voice.
Right, I'll just repeat the question, Manish. I just want to understand your assessment of all the action that has taken place, because if we look at the last 4-5 months, the markets have seen a lot, whether it's on the downside or whether it's a speedy recovery as well. There's been much talked about rural revival. There's been much talk about mid-cap and small-cap frenzy gaining momentum as well. So what is your assessment of it, and where do you think we're headed?
In the last 6 odd months or so, clearly we've seen a very seesaw behavior, both from an economic perspective as well as from a market perspective. We've seen Nifty go down as much as almost 8,000 levels, and today it's back to above 11,000 levels. So I think an average investor, if he's confused today, I'm not going to be blaming him. A lot of the investors I know personally have kind of exited the market in late March at around 8,500 levels of Nifty, who are very confused today. At one side, there is this whole fear that you're missing out on the rally that you're witnessing as the market is going up. And on the other hand, there is an apprehension that the market has also run up a lot. So what do you do? Do you play for the recovery, which is going to come through in the coming quarters? The rural revival, as you very rightly pointed out, or do you kind of look at the current situation and remain afraid in terms of the numbers of coronavirus that are coming through, the GDP numbers that are coming through, and how do you play? I think when the whole situation is in as much a turmoil as it is today, and the way it is behaving today, the best thing to do is to play it from a long-term perspective, have a 2 to 3 year investment horizon, and have a clear head that the market might be intermittently a little volatile. Your investments might be -5 or +5% down. But then you have a clear trajectory in terms of the amount of time you want to stay invested for. You have a clear time frame in terms of the target return that you're targeting, and then you stay put for that time frame through the whole upheaval and turmoil. See, the way I look at it, if you take a slightly broader term view, if you take a slightly longer term 2-3 year view, then clearly the economy is on a mending path. Q1 is going to be the worst quarter that we are witnessing. I continue to remain very, very optimistic as far as banking is concerned, as far as consumption is concerned, as far as the whole rural play is concerned. Sectors like pharma, again, should do really, really well. And we've seen things playing out over there as well. So my sense is that, when you look at discretionary consumption, when you look at BFSI, when you look at pharma, there are things to play out for from a 2-year perspective. And there's no doubt in my mind that FY22 and 23 are going to be the years when there is going to be a significant amount of mean reversion in the economy from a GDP growth rate perspective, from an inflation perspective. Rate cuts are going to come back. My view over here is that do not try to time the market, but try to spend as much time as possible in the market and invest from a 2-3 year view perspective. There is a lot of money to be made in the equity markets. The rally that we've seen in the last 2 months is just the tip of the iceberg. It's just a starting point for a very long rally that is going to come through in the next 2 years.
That's very heartening to know. Manish, what are the kind of concerns that some of your clients have been flagging off over the last couple of months, and how are you at Ambit trying to provide solutions or provide some kind of relief or services in terms of your research, in terms of your analysis to your clients?
So I think the biggest concern everybody at the moment has is valuation. And this is something that has been consistent for a very long period of time now. For almost 2.5, 3 years, I think since the starting of 2017, we've spoken so much about polarization. We've spoken so much, about valuations in certain sectors and certain stocks rising to the level where it has risen. And the only question that I keep getting intermittently where people are always concerned is how to get around these valuation multiples and how to invest correctly in these quality stocks, if you may want to call it, and the valuations where they are trading at. And what I often tell people is two, three things, right? One is that if you look at Nifty, in the last 10 years, actually Nifty has seen a significant deterioration as far as the earnings growth trajectory is concerned, right? We started off in the last decade in 2011, with a 28% earnings growth in Nifty. Today, we are in a negative trajectory, and the trajectory has been sliding down year after year, every single year, right? And if you look at the multiples that the Nifty is trading at, has actually remained by and large in a very narrow band of about 15 to 20, 22 times, right? So we've not really seen a significant performance as far as earnings growth is concerned from the broader markets, and we've not really seen multiples being re-rated at all. And that is why if you look at the last 3 or 4 years of returns that an average mutual fund has given or Nifty has given is abysmal. On the other hand, companies that have performed consistently in the last 10 years, right? For instance, if I may, you look at the coffee can portfolio, you look at the good and clean portfolio that we have, 9 out of the last 10 years, there has been a double-digit return, right? In terms of profit growth that these companies have given out. And the market has rewarded them very rightly. When you look at the composition of balance sheet, when you look at the composition of their consistent growth in the past and the future growth outlook, these multiples automatically get justified, right? So what I tell people is to do two things. One, to look at not multiples in isolation, but look at risk versus reward. And second thing is that as long as earnings continue to grow, you'll always outperform the market irrespective of what happens to the multiple or what doesn't happen to the market.
Okay, right. Makes sense. Talk to us about any of the recent analysis you all have done with regard, which is suitable to the long-term investor, which could have potential to create significant wealth. Any changes in your portfolio or your analysis that you may have made in the recent past that you'd like to highlight?
Sure. So if you look at it, there are two things that we've done in the last 3 or 4 months as coronavirus has unfolded in front of us. One is to do a survival test, on companies, right? And our belief here really is that if you take a 2-year view and you believe that companies, which are going to survive, who are market leaders in their segments, I think they're not just going to survive, but they are essentially going to thrive. There is going to be a certain shift in terms of market share that is going to happen from smaller companies to bigger companies. The MSMEs, the smaller, manufacturers are going to find it a little difficult to kind of hold on to their market share positions the way they currently are or were before coronavirus crisis came into being. And hence the big guys are going to become bigger. And also there is a certain revolution which is waiting in the wings to happen as far as the logistics sector in India is concerned. When you look at the way automation is going to come in, when you look at the way robotics, artificial intelligence is going to come in, people are going to cut down on layers that exist today. There is a certain bit of increase in profitability, which is also going to happen. So the big are going to become bigger. And, they are also going to become more profitable. So guys who are able to survive the next few months are the guys who are going to thrive over the next 2 years. So it is irrespective of the sector in which you're investing in, be it BFSI, be it, pharma, be it, retail, be it consumption, discretionary consumption. Invest in leaders. If you invest in market leaders, believe me, your portfolio is going to do much better than average Nifty is going to do. So that is one. Secondly, in terms of the changes in the portfolio that we have made, what we've done is we've not sold anything yet. We've not cut down our weight on anything yet, but we've deployed a certain bit of excess cash that we were sitting on into 2 sectors, which is life insurance, and second one being modern trade or retail, where we believe both of these sectors are going to see significant amount of benefit coming through at a category level or at an industry level because of the coronavirus crisis. The growth is going to accelerate from here onwards. So we have taken a slightly longer term view. The valuations, of course, were far more compelling than what they have ever been. And those are the 2 sectors where we have kind of taken a slightly more bullish stance.
All right. Could you also give us a sense of how the portfolio earnings estimates are looking, given the recent disruptions and earnings that have slipped further, like you said? Has there been any revision at all to your estimates of your portfolio's earnings?
Not really. See, a few and far in between intermittently, but by and large, if you look at a portfolio composition, when you look at the F&B companies, in the portfolio that we hold, when you look at BFSI names that we hold, we have all market leaders over there. When you look at the discretionary consumption names that we have in our portfolio, I think by and large, earnings so far have been either ahead of estimates or they have been significantly ahead of estimates, as I may call it. So even when we looked at FY20, right, Q4 FY20, we were still in double digits as far as earnings growth, bottom line of the portfolio is concerned. When you look at full year FY 20, we were in double digits. And I think FY21 really is going to be a bit of a year of disruption, especially most in the first half. But we are very confident of a very significant V-shaped kind of a recovery happening, not just in the markets, but in the earnings as well, and more so in our portfolio. So not really been a very significant negative reaction to the results, not really seen too much of earnings cut coming through in the stocks that we have held. In fact, if at all, our portfolio continues to perform really well month, 1 year, 2 year, 3 year view consistently. So we've not really had, to answer your question in one line, had
I think we lost that line with Mr. Jain, but we largely got a sense of how his portfolio has done amid all the disruptions, the sectors they're betting on, and how they continue to bet on the names that they've invested in as part of their portfolio, and they've not seen any significant impact or change to their estimates for future growth as well.